Well, welcome everyone. Thank you for joining our webinar this afternoon. We appreciate you taking time out of your schedules to be a part of this. Our topic today is business succession planning. And in particular, we're going to talk about 3 things you need to know before selling your business. But given the unprecedented economic situation we find ourselves in, we know that none of you are unaffected by the coronavirus. And so we're also going to incorporate our perspective on this pandemic and proactive actions you can take right here and now. So, I'm Chad Hamilton, Director of Practice Management for Brown and Company. We'll attempt to cover our presentation and prepared remarks within the next 30 minutes, and then we can open it up for any questions you have. We have the slides available afterward, as well as a recording of this presentation. As for Q&A, rather than open the lines for questions, we're going to receive them while we proceed, and we'll read them off and attempt to answer them at the end. You don't have to wait until the end of the webinar to ask a question, though. You can submit it along the way at any time. We'll be collecting those throughout our call. Before we jump into the agenda, I wanted to take just a minute to share this chart. It shows visually the relative exposure to the coronavirus of different industries. Now, no one's unaffected by this pandemic, of course, but the truth is, that's being revealed here is that the impact varies significantly based on the industry that you're in. Those that are highly exposed in red are typically the discretionary expense related industries: hotels, airlines, apparel. Those are going to feel the effects that much more than those that are in green, like the telecoms, waste management, or food retailers. And then in the center, represented by the light blue circle, these are the ones that could actually have a positive correlation to the current calamity. That list, unfortunately, is small, but internet service companies, online retail, and gold mining are 3 that are listed here. Anyway, just an interesting visual we wanted to share, though we might quibble with a few of the categorizations here. Nonetheless, we think it's helpful. And so 3 things that you need to know. Here's the agenda for our call. 3 things a business owner nearing transition or exit from a business should know. Number 1, what we're going to talk about is, how do you prepare yourself and your business for exit? Are you familiar with the most common mistakes business owners make when selling their companies? And do you have a vision for what your life will look like after you exit? Planning is like a puzzle where all these pieces need to fit together, but the single most important piece of the puzzle is the picture on the top of the box. Without knowing that, without knowing what you're trying to put together, it's really hard to go about building that scene. And the same is true from a personal financial planning standpoint. If you spend 20 years or more in your business, what comes next? What does the next phase of life look like? Really important to understand that. The second topic is how to create a sustainable stream of income in retirement. Do you know how you'll, quote unquote, get paid after you sell the business? The task of moving from accumulation to distribution mode is a big one, and you want to make sure that you have a plan to create income that will last for several decades and keep up with inflation. And then thirdly and last, how can you maximize the value of your business and minimize income taxes? So that's what we'll be talking about today, and we're going to jump right in. Uh, the business owners we work with are typically great at creating wealth, at taking an idea and building a successful, profitable business from it. But they generally have very little or no experience in selling a business or transitioning it to employees. So if you own a closely held business, it's critical that you have an exit strategy worked out in advance to help ensure that you meet the personal, financial, as well as business objectives that you're hoping to achieve. This visual here just shows the 4 primary exit routes for business owners. Option 1 is to transfer to family members. So just kind of give some pros and cons of each. The pro or benefit of that is it puts the company in the hands of a known entity, specifically one's own flesh and blood, who the owner believes will run the company as he or she did, providing for the well benefit of the owner's family, perpetuating the company's mission or culture, keeping the company in the community, and allowing the owner to remain involved in the company in most cases. The cons with this, the big drawbacks, is that without planning, there's little or no cash at closing available for the owner's retirement typically. There's also the ongoing financial risk to the owner, and it requires the owner's involvement post closing because children may be unable or unwilling to assume the ownership role. So, family issues complicate treating all children equally or fairly as well when you have a family transition of a business. The second option, the sell to key employees. So the benefits of this is that it puts the company in the hands of a known entity. Uh, it perpetuates the mission of the company, much like the family transition does. Keeps the company in the community, allows the owner to remain involved in the company, and may allow them to achieve financial security. The cons are without planning, there's little or no cash at closing available for the owner's retirement, and the owner experiences ongoing financial risk. It also requires the owner's involvement in the company post closing, and employees may not be able or willing to assume that ownership role. A third option is to sell to a third party. So, with this, you're able to typically achieve the maximum purchase price, and it usually maximizes the cash at closing. It allows the owner to control the date of departure and facilitate future company growth without the owner's investment or risk. Now, the drawbacks to this is often a loss of owner identity. What do they do next? What does life look like after it's sold to a stranger, essentially? The loss of corporate culture and mission can be a big one. Receipt of perhaps significant part of the purchase price subject to post-closing performance of the company, and then potentially it can be detrimental to employees. A fourth option is to never retire. The pros there is you remain in control, you preserve the company culture and mission, minimize risk, or at least the owner's perceived risk is low, and maintain or even increase the cash flow with less risk of income loss. The negatives there is minimal proceeds. Of course, there's really no proceeds from a liquidity event. It has a negative effect on employees or customers who might want to know the long term plan. And it continues to experience risk associated with ownership or never able to get away from the business or embark on any significant post business life. Those are all risks. Now, absolutely central to this whole conversation, including the decision of how to best transition your business, looking at the what we just talked about, is the question of how much do you need to net from the sale of the business to be financially independent? What is your number, so to speak? So we like to look at this calculation in terms of net present value lump sums so that it's easy to interpret and evaluate where you stand. The blue line represents your total capital available. That's your investment assets, including your business, any investment real estate, 401k, bank accounts, and other investment accounts. It does not include personal assets, the value of your home, or any kind of vacation home. The red line represents your capital need. That's the total cost in one lump sum of all your future estimated living expenses and plus one-time financial goals or gifts that you plan to make. If your capital needed is greater than your capital available, you want to figure out how to grow the business to close that gap. If, on the other hand, your capital available is greater than your capital need, you may have excess wealth and the opportunity to do some gifting, as shown here. Our goal is to create financial plans that are growing in retirement, which means you have more than you need. We've named this surplus the retirement shock absorber, and having one should help you feel more secure about your financial future, easing those sleepless nights. The retirement shock absorber is one of the most important during these times of volatility and market decline like we're seeing now. And so I just kind of give you a sense of how this works. This is an example of a retirement needs analysis before the market downturn that we've seen. All right, just hypothetical numbers, and don't get caught up in the amounts. It's just a way of showing this. And here we're showing that there's a 30% shock absorber. Right, there's 30% more than you need in this case. Now, let's take a look at this after this downturn, which has happened remarkably fast. And let's assume that now your assets are down by about 18%. And you still have a shock absorber there, but instead of 30%, it's 12%. Okay, so you may not feel great about looking at your account statements or thinking about what your business offer might look like, but nonetheless, in this case, having built that shock absorber in, you're still okay. You can still meet your future living expenses and do what you want to do, hopefully, in that case. So that's the thinking behind the shock absorber and why it's so central to the planning that we do. Now, estate planning and all the planning around that is sort of like a pyramid where you have foundational planning at the bottom, wills, revocable trust, powers of attorney, which are all really important as kind of a base and a foundation to have in place. And then as you move up the up the hierarchy here, there are different levels of planning that you can do, like a residence trust to get your home and personal residence out of your estate if there's an estate growth and estate tax concern. And then irrevocable life insurance trust can be another way to do that without losing a whole lot of control, but still allow for liquidity in your estate for your heirs. And then more advanced planning can be charitable strategies and retained interest giving, like grats or slats or things along those lines. Now, secondly, we want to move to our second topic. How do you create sustainable income in retirement? And here we're thinking about this big move from the accumulation phase to the distribution phase, and how you need to think about things differently at that point. Now, it may sound counterintuitive, but people typically overestimate their tax liabilities in retirement. Income taxes may actually be quite a bit less than you experience during your working years growing your business, even if your standard of living remains the same in retirement. And the reason for that is before retirement, there are only a few things you can do to reduce your tax burden: retirement contributions, charitable giving, um, in some amount of deductions for your business. But for the most part, you don't have that much control over your tax burden. But if you plan ahead in retirement, you can have a lot more control. And the reason for this is there are a number of different buckets of money to pull from, each with their own different types of tax treatment. And for many of these, you can turn them on and off depending on the tax implications of your personal situation. This tax filter is an interactive tool we've developed to help our clients manage their portfolio and make the most of that money by optimizing the amount of income and minimizing taxes. One of the goals of this tax filter is to basically max out those lower brackets without creeping into the higher brackets. It considers all those sources of income that you see here on the screen. And this just allows you to see visually how to strategically pull from those different buckets and create the most tax efficient plan for income. Now, to the third and final point in this presentation, we want to think about how to maximize the value of your business and minimize taxes. We work with entrepreneurs all the time, so we know how much time, effort, and dedication it takes to create a successful business. At the end of the day, you want to know how to maximize that value that you've spent, in many cases, decades building in order to meet your personal financial goals. It's never too early to begin thinking about how to exit and the various ways you can think about creating and increasing how much your business is worth. So this visual shows kind of the higher risk, lower return aspects on the left side, and the lower risk, higher return attributes on the right. As you move from the bullet points on the left to those on the right, they translate into a business that's more attractive to buyers and consequently a higher EBITDA multiple for your business. Now, here are 5 ways to make your business more attractive to potential buyers. We just want to kind of sum up the bullet points. First, having standard operating procedures in place. The difference between your business being an extension of yourself as opposed to a self-sustaining entity comes down to the systems you have in place. Have you created workflows, checklists, procedures to ensure that the business can run like a finely tuned machine without you being essentially a bottleneck to the process, because that's often a problem with owners. Um, Second is the management team. The successful implementation of these operating procedures is contingent on your business having a motivated and stable group of key employees that have the judgment and experience to autonomously run the business. The ultimate test of the effectiveness of your management team and your systems is whether you can take a 1-month vacation and come back to a business that's operating smoothly and even growing. Of course, the challenges we're having now in the midst of this unprecedented healthcare crisis is testing some of that, the team, the process, and the ability to work virtually for many businesses. Third is diversification. Do you have a diversified base of customers, suppliers, and products that'll create more value in your business because it reduces the risk for a buyer? I mean, imagine a business whose cash flow is dependent on 1 or 2 customers. Why would a prospective buyer spend millions of dollars only to have those customers go elsewhere after acquiring your company? That's always going to be a concern. So too much reliance on a single customer, a single supplier, a single product line can threaten the viability and value of your business. Fourth is growth potential. So buyers pay a premium for businesses with a realistic strategy for growth. Often the best way to do this is to focus on a certain niche of customers and differentiate your business by creating a unique product or service to serve that niche. And that's what investors sometimes call a moat, or a sustainable competitive advantage against similar firms. The wider the moat, the more sustainable growth potential a company has. And the size of the moat's driven by things like brand identity, intellectual property, and technology. The fifth and final lever to pull to increase the value of your business is financial statements. You put yourself in the shoes of a prospective buyer again. Now, after hearing that your company is generating millions of dollars in revenue per year, their response is going to be, prove it. This requires that you get your financial house in order ahead of time so that your organization and record keeping is consistent, easy to understand, and accurately and favorably reflects your company's cash flow and balance sheet. Now, when it comes to taxes, the time to think about tax minimization is in advance of when you are in the process of selling your business. And the sooner the better with most strategies. Once an LOI is signed, it's too late. So if you're charitably inclined, here's a tax planning strategy that allows you to give a portion of your business to causes you care about and create a stream of income to live on. The one strategy, this one strategy provides 3 answers to common questions business owners have. First, how do we reduce our tax bill? We hear that all the time. It's a very important question. Second, how do we create income in retirement from the sale of the business? And third, what's the best way to give a portion of proceeds to charity? If all three of those questions are relevant to you, then you might want to think about a charitable remainder trust before the sale. You transfer shares of stock into this trust ahead of time. And what it does is eliminates capital gains taxes that would otherwise be owed after the shares are sold. In addition, you're able to reduce your income taxes by leveraging a special type of charitable tax deduction. This also increases cash flow as compared to what it would be had you depleted the balance due to taxes. This is just a flow chart that shows how assets flow and how income is paid out when a charitable remainder trust is set up. The other idea for minimizing taxes is a strategy called tax loss harvesting, and that's for your non-retirement investment accounts. Now, this is the silver lining in the midst of an otherwise pretty dreadful financial situation we find ourselves in at the moment. What it allows you to do is lock in losses that you can use to offset capital gains from this future liquidity event that we're talking about today, right? So the concept is simple. You sell a security in your taxable account, and that's at a loss, and you take that tax benefit this year and simultaneously you buy a similar security so that you stay invested, and you stay essentially invested in the same kinds of things, but and that new security then replaces the one you sold to maintain that position in the market. Selling securities that have losses in accounts that pay taxes can reduce your tax liability, and then what you do is you carry forward those losses indefinitely into the future and use those as an offset against capital gains from a business sale. Really important time to be thinking about this right now. This is a unique opportunity that can allow you to keep more of your money in your pocket when you sell. So how does this all come together? We want to give you a look into our process, because there are a lot of different pieces to this. Real quickly, just at a high level, phase one is a diagnostic inquiry. Our buyout barometer tool is designed to ask you questions that you don't know the answer to, but typically you should, right? And that helps uncover and identify areas to focus on. Who runs the business if you're no longer around? How much is the business worth, and how much does it need to be worth in order to meet your goals? Those are examples of questions in our buyout barometer tool, and some of the things that we look at right at the beginning of the process. Phase two is initial data gathering, getting financial data prepared to put together a baseline financial plan. Phase three is financial independence, and that gets into this retirement shock absorber I showed earlier, where you compare your capital available to your capital need and gives a really good framework to where you are versus where you need to be. Fourth is to review insurance coverage as well as business and estate documents to identify any particular potential problems. That's all about contingency planning. And then fifth is looking at the value of the business and beginning the process of establishing priorities to build value, recast financials, and benchmark against the industry. Phase six is evaluating different options for minimizing taxes in advance of a liquidity event. A couple things we just talked about. And then phase seven, we want to facilitate introductions to the appropriate advisors if you don't have them already, depending on your transition plan. And it's really important to have that team of advisors that works well together so that everyone is on the same page and it's all coordinated. And then lastly, portfolio management to implement recommendations and provide for sustainable income after you sell the business. So what's the best thing to do right now in the midst of everything? We think that having a plan is crucial. It gives, if you have a financial plan in place, it gives a proper context and framework for evaluating the effects of the downturn on your situation. And we have tools like the retirement shock absorber to help simplify this that we talked about earlier. The best place to start, in our opinion, is this recession prep scorecard. For our clients on the call, you've heard us talk about this, but it's a good reminder. It's just a one-page synopsis of various metrics that assess the health and stability of your financial situation. We look at things like the shock absorber, like I mentioned, as well as the amount of liquidity you have, your allocation, whether you have hedged vehicles like annuities, real estate, or other investments that could provide other sources of income or downside protection. We consider your withdrawal rate from the portfolio, when you need to be living off of it, whether you have any debt, and we take all those factors into consideration and we score it on a scale of 0 to 10 that assesses your ability to absorb and sustain a downturn just like the one that we're in, and see if what that all looks like. And I think now is a good time to assess that and take a look. And if you're not currently a client, we're happy to put one of these together for you. So just reach out to me and let me know, and we'll be happy to do that. So now I just want to take any questions that we have. We did have a couple come in. So one of the questions was, what types of investments do you like right now? Okay, at the current moment, we have a higher quality bias. So our tactical moves in the portfolio have to do with um, a bias toward bigger blue chip companies that are going to continue to do better during this time, in this economic environment. Higher quality companies are generally more expensive, so our bias is going to be toward U.S. over international, large company over small companies, and growth over value. That can change, but right now, those are the kinds of companies that we think will sustain, and some will even thrive even in the midst of this challenging environment. There are a lot of really solid companies right now, and we need to think about this, that are trading at a discount. So remember, when you're investing, you're buying multiples of future earnings, which means buying 15 or 20 years of future cash flows. And if you think about it that way, decades of future earnings, then the difficulty these firms are facing currently and possibly even in the next year does not warrant them being sold off to the extent that we're seeing now. Second question, if you have cash to invest, or now or in the near future, how would you do that? Gradually put it in the market or in a lump sum? That's a great question. And actually, I think I almost had some as part of the presentation, but for purposes of brevity, we kept that out. So let me see if, um, yeah, we've got some visuals here. So the short version of our answer is that for those of you that have a liquidity event coming up, if you're thinking about selling in the near future, say within the next year, um, real estate or a business or any kind of liquidity event, we favor investing the proceeds systematically over a period of time. And that can be anywhere generally from 6 months to 18 months rather than all at once. Um, Even though we're down 30%, I mean, today we're up, so it might be 25. It's hard to keep track from day to day, but things could still get worse. And, on the flip side, even if market trends continue upward from here, it's highly likely that the volatility we're seeing will continue for some time. So, in other words, that path will likely be very jagged regardless. And the advantage with a systematic or opportunistic investment plan is that you can take advantage of volatility. The swings in the market will work in your favor because you're buying less shares at higher prices and more shares when the prices are suppressed. And that's just what this is showing here. If you have a lump sum investment, we looked at June of 2008, just to look at a really volatile time. And what you can see here is if you had $4.5 million, you invested it all at once, you could buy about 35,000 shares at that point in time of, just assuming the S&P 500 index. If you put it in systematically, so you had 6 payments quarterly, 6 investments of $750,000 each, every 6 months, you end up actually buying 10,000 more shares. And the reason for that is you're buying more when the price is low and buying less shares when the price is high. And you can just kind of see it here with the numbers. But that's the idea. And it works really well in a market that's just extremely volatile. And so this is a point in time where we think that type of thing will probably pay out. And even just psychologically, not having it all invested all at once right now is probably a good idea. And this just shows the systematic buys in red as opposed to the lump sum in blue, and you can see there's a huge difference there. The total investments, the black line, 4.5 million, and what you can see is over $1 million difference between the two, and being rewarded by that systematic buy plan. So that's our bias at this particular moment in time. That's not always the case, but right now we think that makes a lot of sense. If you're trying to get a lump sum invested, we would recommend doing it gradually. All right, I think that's it. I don't see any other questions that came in at the moment. So thank you so much for your time. The one thing I just want to say here is that um, we've got some resources at these websites up on the screen. We'll share the slides with you. And then lastly, I just want to say, no one knows how long this will last, but we do believe it will get less weird, less shocking as time passes. And this will be part of our history. It'll contribute to our national subconscious, just like 9/11 and the Great Recession have done. And we really do believe good things will come out of this. We look forward to seeing what those are. If you find yourself at home, create a plan to use the time productively, time with family, time to cook, time to work out, um, and catch up on shows, whatever it might be. Time to plan your future and slow down for a minute and try to take advantage of that as much as you can. We thank you all so much for your time. Be safe and all the best.